Hi everyone, welcome to Behind the Numbers. This is the show where we dig a little bit deeper to understand what really matters most in business. My name is Dave Bookbinder. I'm a Senior Director of Valuation Services at Pine Hill Group. Today we're going to be talking about mergers and acquisitions. I'm pleased to welcome my guest today, Mark Gaeto of Falcon Capital Partners. Mark, thanks for joining the program.
Hey, it's great to be here, David.
So Mark, I always start out with having my guests just very briefly talk about who they are and their firm, and then we'll take a dive into the issues at hand here.
Yeah, sure. My name's Mark Gaeto, and I'm an investment banker with Falcon Capital Partners. I grew up in the software industry, primarily in sales and marketing, and ended up running a company that I sold, and that kind of got me into banking. And Falcon is a bank that focuses on technology. We have a very large healthcare practice, and then we have a commercial technology practice as well. And regionally, we focus on commercial and industrial too. Practices are the tech practices are national in nature.
So just to clarify for our viewing audience, you use the term banking. We're talking about investment banking here, not commercial banking, just a term of art. Just to
That's
clarify.
right. We do M&A work. We transact companies. We are advocates for owners, primarily, who want to sell their businesses or raise capital or acquire additional businesses.
So what's a typical client for you, Mark? What do they look like?
Typical client is I'd say anywhere from a $5 to $50 million software or software-enabled service on the tech side, or a $20 to $100 million industrial business. Usually it's privately held. I'd say about 20% of the time, 30% of the time, it's institutionally owned. The goal is for that owner or management team to exit. And they exit because primarily it could be retirement, or they could be just in a position where they know that if they raise capital and get some institutional money, they can grow faster, or just the firm needs to be in a larger home to secure the legacy and longevity of the company.
Is there a typical time in the business's life cycle that they start to have conversations with you? Or when they should have conversations with you?
Well, I believe that companies should touch base with a banker every now and again. I think there's usually an inflection point, and it's usually someone wants to retire, someone wants to buy out a family member or a partner, or they're being approached by their competitors or by private equity firms who are interested in acquiring the firm. And my advice is don't jump at that, because there's a lot of preparation that one needs to go through in order to optimize the sale and optimize their wealth, and just professionalize the firm a bit so they can withstand the diligence that's usually pretty intense.
Yeah, let's unpack that a little bit, because you touched on a lot of really key points here that I think business owners really need to understand. Maximizing value, don't jump, and getting prepared. So an exit is a process, it isn't just an event. You want to speak to some of those issues and help business owners understand what really is involved in the process?
Yeah, sure. I mean, you said an exit is a process, and it is. We call it a project. It's a project plan. And projects have beginning and end and milestones and objectives. And so we typically ask people to kind of slow down. And one of the things that we find out when we dig into firms is typically their accounting's not professionalized enough to withstand diligence. What I mean by that is, most business owners see accounting as a necessary evil instead of a system that helps them measure performance and drive decisions and drive their strategy. And also a way to help them understand how they make money. So, where's the revenue coming from, how it flows through the business, where's the margin capture points. And once they understand that, they can drive the business a little bit better. So accounting is something that we focus on, because many times the investors, even though they may be looking at this from a more strategic perspective, want to know what the cash flow is of the business.
Quality of earnings, is that an important matter?
Very important. Quality of earnings, that's becoming more and more important today. We see more and more business owners going through a pre-transaction quality of earnings, or could be a heavy or light, depending on the state of the accounting. And this way you have a set of transaction-ready books, as well as an outside independent party kind of providing a report that you can hand off to investors or buyers and say, hey, we're good, we're in good shape.
Yeah, well, as you know, I do valuation consulting, have done it for a very long time. Yeah. And in the concept of the business value, and I'm also a former investment banker, so I understand the process a little bit, but I've told clients in the past that if they're in the due diligence process and they're spending their time explaining away historic performance, normalizing adjustments are one thing, but trying to explain things in a diligence process as opposed to handing somebody a clean set of financial statements suggests that there's maybe more risk in the business. And the more risk a buyer perceives, I think the greater the likelihood that they're going to see a reduced valuation. Does that jive with what you say?
Oh yeah, David. So the risk meter, as I call it, shifts greatly. Many firms, when they, for example, if a firm tries to sell on their own and the buyer comes in, we've seen deals just fall apart because the buyer or the investor doesn't have a lot of confidence in the numbers. With a quality of earnings report or just some basic cleanup, it reduces that risk meter gauge, and gives comfort to a buyer that they can follow the numbers and the firm has been professionally run, and there's no ghost in the closet. There's no hiccups or.
So you do a lot in the tech space. Mm-hmm. Are you finding that there's a preference for strategic buyers or financial buyers?
Well, look, I mean, you're going to get your most value with a strategic buyer, 100% of the time, in my experience. But the financial buyers are really important for people who still want to stay with the business, still see growth ahead of them. So there's many types of financial buyers. There's pure buyouts, they want to buy you and leave or have you stay on for a transition period. But there's we see most of the technology investors that bet on the management team. Much like a venture firm would, but bet on the management team, allow that management team to take some money off the table, allow the firm to professionalize itself with better practices, maybe a handful of new executives, and then capital to go fund development, grow a sales force, or make some acquisitions. So in that situation, that kind of double bite of the apple, your initial valuation may be less and you might sell 60 or 70% of the business. But that second exit could be just as valuable as the first, if not more so.
Yeah. Mark, tell the audience how they can contact you if they want to learn more.
Sure. Best way to reach me is go to our website at falconllc.com, www.falconllc.com, and all our contact information is there.
Let's spend just another minute or two on valuation, if we could, since you brought up the subject and it's near and dear to my heart. We were talking before the program, and you mentioned something that really resonated. You like to sell beyond the numbers, I think is what you said. And the show's called Behind the Numbers, so there was a resonance there.
Yeah.
In your assessment of a company's value, you look beyond the numbers. Can you talk a little bit about that and what that means for business owners?
Yeah, so kind of how we differentiate ourselves from other banks is that we're former operators. We worked for big companies, we parachuted out, we started our own companies, we raised capital, we bought companies. One of my partners had 2 public rides. So we have this operating mindset. So when we get into a firm, we're not just looking at the numbers. They're very, very important, but we're looking for other levers that we could pool to maximize, the wealth of the shareholders and the value of the firm. And for example, we'll look at the management team. We'll look at the intellectual property, of course. We'll look at the markets and geographies that get served, and we'll try to make sense of all that and kind of position additional value beyond the numbers.
Yeah. What do business owners need to be most aware of as they start to contemplate the selling of their business?
Well, there's a lot of things. I mean, we talked about how your books need to be properly, prepared and transaction ready is the term that we use. But there's other things too that get people that cause issues as you go through diligence. And legal is a big issue. Do you own your international? Do you have a straight line to ownership on your IP, on your software? Are your contracts set up so that they actually help you capture margin and recognize revenue? Is your revenue recognition policy in line with how you're contracting or licensing your software or your service? Do your employees have certain agreements in place? So sometimes there's a big issue around consents. You might have contracts where you have to get a consent in the sale of a company, and depending on how that language is written. So there's always things that pop up. There's always something that you miss, so you really have to go through kind of a multi-step pre-diligence cycle with a banker, with your CPA firm, with your attorney, so that you know everything about the business and can explain it and disclose it and allow people to investigate it so that they get that comfort and they could provide the value that they've initially offered you.
Yeah, more transparency, greater valuation.
So
we've got to take a quick break here on that note, Mark. So don't go anywhere, and you don't go anywhere. We'll be right back on Behind the Numbers after this commercial break.
Rowan College at Gloucester County, low cost. The #1 nursing program in all of New Jersey. More than 70 programs of study, including selective admissions. With record enrollment. A premier partnership with Rowan University. Transfer options with numerous universities. 4-year degree options on our campus. Rowan College at Gloucester County. Now you're thinking.
Choosing Medicare coverage can be a very confusing and complicated process. Help is just a phone call away, 856-226-4800. As a licensed insurance agent, I'll assist you in making an informed and confident decision on a Medicare plan that meets your needs, lifestyle, and budget. Call me today for a free, no obligation Medicare benefits consultation, 856-226-4800.
When did you see the sign?
When I needed to create a better visitor experience.
Improve our workflow.
Attract new customers. That's when Fast Signs recommended Fleet Graphics.
Yeah, now business is rolling in. Get started at fastsigns.com.
What do I want to be when I grow up? Maybe a musician? A veterinarian? Maybe an equestrian? A mommy? Well, why not be all these things and more? Consider joining me, Dr. V, with friends and colleagues as we explore a wide range of topics together. V is for variety, here on RVN TV.
Hi everyone, welcome back to Behind the Numbers. I'm Dave Bookbinder. Today my guest is Mark Gaeto, a managing partner at Falcon Capital Partners, and we're talking mergers and acquisitions. And Mark, during the first part of the program, you mentioned something about the operational experience of the Falcon team. How does that help you and your clients when you're going through the M&A process?
Yeah, look, so when we talk to owners, a lot of times they ask, when's the best time to sell, or what's the best exit strategy? You see a lot of people talking about exit strategies, which is a little bit about what we talked in the first session of the show, just getting your books and legal stuff, in place and updated and all that good stuff. But from an operator's perspective, we also talked about how, Ted, Carl, and I are operators, former operators that have, run firms and invested in firms and stuff like that. And we always say your best exit strategy is a growth strategy. So do all that, exit stuff. You need to get your books clear and more granular, more professionalized, and the same with legal. But what we typically ask companies to go through is kind of a visioning session where, we want to know, where you're going, how are you going to get there, what's going to make you successful. So, and we want to kind of bound that in a 3-year period, and then we want to know, what are the initiatives that you're going to execute on. Typically, there's 3 initiatives. It's a selling and marketing one, it's an R&D one, it's a funding one, and sometimes there's one around talent too, right? I need to upgrade. And so then we say, great, you have these initiatives. Let's put plans to them. Let's put budgets to them. Let's assign responsibility. Let's make people accountable. Let's give them metrics so that they can measure performance. And let's have a regular cadence of performance meetings. From a weekly update to a monthly review, quarterly deep dive, and then just an annual, or set back, reset type of session. And so I think when people get into that cadence of understanding where they're going, how they're going to get there, and why they're going to be successful, which is really why are we, what's our competitive advantage? Why are we investing in that? How are we investing in that competitive advantage? That gives people really a clear direction to how to grow the firm, and growth is what people pay up for. They pay for growth in revenue, they pay growth in margins, they pay growth in market share, and so. Again, we can go on for a couple hours on this, but your best exit plan is a growth plan. So
That's a great soundbite. Your best exit strategy is a growth strategy. I really like that a lot.
Thank you.
A lot, Mark. Thank you. Let's talk a little bit about valuation, but from a transactional perspective. 2 companies, similar financial performance. Let's say that we might value them at $10 million each.
Yeah, I just was. I'm sorry.
They don't necessarily transact at the $10 million, though. There's differences that I want you to speak to.
Oh yeah. I just gave a presentation kind of on this subject out in Denver a few weeks ago, and the question that came up is, hey, you sold company X for Y. Ergo, therefore, my company should be sold for the same amount. It's like, not necessarily. But why not? We're in the same industry. Our solution set's pretty similar. Why not? And it really comes down to, in the software industry and software-enabled services industry, 2 or 3 different firms could be at that 10 or 20 or $30 million level of revenue. But how that revenue flows through the P&L and how it generates cash and margin, and how fast someone's growing or how fast someone's burning cash or adding cash is really what drives value for any given buyer. So again, it goes back to your growing the firm. If you're growing your top line and you're able to grow margins, that's great. You could be growing the top line though at 100% and losing money, and that's still incredibly valuable for people. So that's that sexy SaaS software company. Yeah. You can be a managed service company where you're not growing, you may be growing at only 15 or 20%, but man, you're generating a lot of cash. And that could be of value to certain buyers as well. And you could be flatlined and making a lot of money, and people see that as a lifestyle business, and maybe you don't get the value that the other 2 companies are. So it's all different. It all goes back to what you do in terms of valuation work. It all goes back to what we said earlier in the show, understanding your numbers, understanding how you make money, understanding how you grow the business, and being able to articulate that in a storyline and have the numbers support that story is what's really important to investors and buyers.
Yeah. For business owners that want to get in touch with you, Mark, how can they do that?
Oh yeah, sure. Love to hear from you. We're at falconllc.com, www.falconllc.com.
So misconception about valuation is one common thread that we both see all the time. What other misconceptions do business owners have coming into the sell side process?
Well, some people think they could transact on their own, and I'm not saying that you can't do that, but usually the valuation is suboptimized, and you may not know what you could have gotten, and you may not know if you could have found a better partner to put your firm into, right? So it's not just about, when you go through a sell side process, it's kind of a matchmaking game too. You want to get the best value, but that probably shouldn't be, and sometimes isn't, the number one factor. You also want to find a home for your employees, for your customers. Yeah. You might want to go along with that firm, and you want to make sure there's a good cultural fit and a good working relationship, with your new boss and management team or investor set. So, I think buyers or sellers, owners, sometimes, don't understand the process and what the process kind of can open up to them in terms of better value or better homes for their companies.
Yeah, one of the questions that I get a lot from business owners is I'm being approached by somebody and they're making an offer and it just really sounds good. Maybe I should take it. And I tried to explain to them about the power of the auction, just the psychology of other buyers seeing an offering memorandum, for example, meaning that they've got to sharpen their pencil. Can you speak to that a little bit to help business owners understand why it makes sense to engage in a formal process?
I would say, this is an educated guess, 30 to 40% of the time, a management team or a business owner comes to us and said, last year I went through a process and it just didn't work out. And company X or investor group Y came to me and we went through this whole cycle and it distracted my company and in the end it just didn't happen. And so, and the reason for that is, everything we just talked about in this show. They just weren't properly, prepped or planned for the exit. So, we see that as one problem. The other problem is, hey, look, there's a lot of money out there on the street. So you're probably getting phone calls from private equity firms, venture capital firms, your competitors, et cetera. Even people that want to, find a business to operate and run. And so people get phone calls all the time, and that makes them feel good. But and it's good that you're getting phone calls, but just understand you're just a name on a list that people are plowing through to see if there's any interest from an owner to sell. So you really got to scrutinize and qualify all these inquiries.
Yep, we use the word process a lot in our conversation. Let's define what that really means. What is it? How long does it take? What can an owner expect if they go through the process?
Yeah, so the length of time actually depends on how ready the firm is to kind of enter into that formal process. So there's a pre-process prep, and that could take a long time. Many times we just sold a firm that we spent 3 years with helping them prep, and that was on purpose. The woman wanted to, organize, grow a little bit, mature a bit, go through a kind of maturation process for the firm before she was ready to sell. And I was glad that we're glad that she did that. We helped her along that, that process. So the pre-prep is one thing. The actual process, could take, my guess is it's anywhere from 4 to 12 months. And that really depends on, the company itself, the market segment, the overall macroeconomics that are taking place in. But if I was a business owner, I would say, hey, once we get you to market, once we get all the artifacts created to launch into a process, it's probably 6 to 9 months.
Okay. You talk about being ready. One of the things I'm asked a lot, which is interesting, business owners want to know, is now the right time, whatever the time of year, whatever the period may be economically, an economic cycle, is now the right time to go to market? And they're playing a market timing game in their mind. Is now the right time versus are they really ready to sell? Can you talk about this concept of the timing of going to market versus being ready to go to market?
Yeah, so timing, look, back in, when was it, 2006, 7, 8, or I guess it was 8 and 9 or around there when we had the recession. That wasn't a good time to go out, right? And then as the market peaked, it was probably a better time to go out, just because the macroeconomic situation was better, and valuations were up there, and people were maybe a little bit more desperate to sell in a declining market than they are in an accelerating one. So timing does play a little bit of a factor, but it really depends on where you are as a person, where the firm is in terms of its evolution and maturation cycle, how mature it is, and then what's driving that decision to sell. And it could be around growth. Hey, I'm a CEO and I love taking a firm from 0 to 20 million, but I'm not that guy who's going to take it, or girl who's going to take it from 20 to 100 million. So I need to put this in a bigger firm, or I need an investor to help me take it to the next level. So gosh, I hate saying it depends, but it depends, right? And it depends on each and every unique situation that you encounter as in your role and in my role.
I hear a lot of business owners say, you know what, I would sell my business, but I don't know what I would do with the rest of my life.
You
hear that?
Yeah, and it's something that you really need to think hard about. We always tell our clients to work with a wealth management company, and the reason that is many of these firms can model out your future post-sale, but also they actually have some pretty cool exercises that you could go through and say, okay, you sold the business. What do you do when you get up in the morning? What do you want to do with your wife or husband? What do you want to do with your kids? Are there hobbies? Is there charity that you want to work on? Or is there the next new deal you want to get involved in? So you really need to think through those things, because there was a statistic that one of the wealth management firms gave us and said 88% of the deals that happen are successful. The owners are successful, that they sold the business based upon valuation and terms. But like 50% of the owners aren't happy because they haven't thought about what they're going to do next with their lives. So they really need to think about that. Yeah. And it's very important. And we, as former business owners, I think we can weigh in on that and help them think that through. All of us sold our businesses. All of us could be retired, but we like what we're doing, and we're glad we're still in the hunt, helping people optimize their wealth, grow their companies, etc.
Great advice. Mark, thank you so much for joining us. That's all the time we have today on Behind the Numbers. My guest was Mark Gaeto of Falcon Capital Partners, and until next time, we'll see you on Behind the Numbers. Take care.
Thank you, David.